For a really, really long time, I genuinely thought the best place for me to invest my money was my own backyard or my own suburb. It was close to home, it felt easy to check on, and it just felt safe. Until I actually realized that every single investment that I made outside of Sydney and outside of my own backyard had outperformed anything that I bought locally. And I mean every single one. And that realization sucked, because the reality is I could have built my $7 million portfolio a lot faster. I've been investing since 2018. I've bought over 50 properties for clients, as well as built my own $7.2 million portfolio. And I'm obsessed with data, supply and demand, affordability, socioeconomics, and just property market cycles in general. And let me tell you, this same mistake is everywhere. Aussies all around the country are obsessed with buying in their own backyard. You've got people out there chasing suburbs that have boomed 80 to 100% in the last 4 to 5 years, just expecting that demand is not going to dry up. It'll just continue perpetually. If you make these mistakes in 2026, it will cost you hundreds of thousands of dollars, more than a normal year. In this video, I'm going to show you which suburbs still have room to move in 2026, the key indicators that will tell you if a market still has upside, and how to avoid safe buys that will quietly destroy your wealth building. The first mistake I see people make is they're trying to chase yesterday's winners. Most investors go and buy where prices have already boomed because it feels like the right thing to do, because it already worked, it already has a proven track record. But they're simply just looking at the last 3, 4, 5 years of data. They usually ignore anything before that. That's called recency bias. When prices go on a run far too hard for far too long, affordability can die in the ass. It can fizzle out really quickly, especially when you're buying in affordable price brackets. So what I mean by that is, let me make this clear. If you're buying in the sub $1 million, especially the sub $600,000 or $700,000 price bracket, affordability is a critical metric for demand. It's always important, but it is even more critical at those price points. And it can mean the difference between a market drying up and going flat or negative and growth. And since roughly 65% of buyers are owner-occupiers, when they tap out, demand collapses. Trust me, you don't want to be buying at the peak when everyone else is exiting, or they will be in a few years. Past performance does not equal future growth. Not always anyway. We want to look at the trends from the past to help us predict what will happen in the future. But the biggest mistake you could make is thinking that because something has performed in the last 2, 3, 4, 5 years, that it will just perpetually continue to do so in the property market. Now, I'm sure that if you were buying in the stock market or you're buying crypto, if something was to go on a crazy bull run, an increase by 30 or 40 or 50% in a couple of days or in a month, you would probably be a bit apprehensive about investing in that stock or in that particular cryptocurrency. I presume I would be anyway. So why would it be any different for property investing? Some dumb logic, but I think it works. The key question you need to be asking yourself is, what is in the early stages of its cycle, not what's already gone up. When the market correction comes, and it will come, those are the markets that are going to get hit the hardest, the markets that have had the most recent growth. Those markets are very likely to have the biggest correction. Now, yes, of course, all property goes up in the long term, but your ability to generate equity and to protect your downside, protect your losses too, is going to hinge on your ability to reinvest, grow your portfolio, build your wealth, retire earlier, send your kids to whatever school you want to send them to, and the rest of it. Mistake number 2 is buying in your own backyard because it feels safe. People will say, oh, at least I can drive past it. I can see if it's doing okay. As if proximity means performance. As if being close to it means that it's going to do well. Has nothing to do with it. It just makes you feel comfortable. Look, if you're a builder or a tradie and you want to get your hands dirty and you're thinking about doing an addition or renovation or things like that, I could probably understand. You want a handyman to go through and fix the broken stormwater pipes or clean the gutters out, regrout and reseal a bathroom, all handyman type of work. It's going to cost you hundreds of dollars, maybe a couple of thousand, if that. And you're certainly not going to save yourself any money by going there yourself, because you ain't doing the work. The best opportunities are not always close to home. In fact, they rarely are. The best opportunities are where the fundamentals align: growth, affordability, demand, and data. Let's follow the numbers. Here's what I personally analyze before I look at any location. Number 1 is market cycles. Which stage of the cycle are we in? Are we in a growth cycle, a recovery cycle, a correction? These are all really important considerations when you buy a property. No one wants to sit on something for 3, 4, 5 years and see no growth, or see 2 years of growth and then see it flatten out. People want consistent long-term growth. Number 2 is affordability. Who can actually buy there right now? What is the income to house price ratio of that particular area based on the ABS data, based on the census data. What are people in that area earning as a proportion of property prices? What is their propensity to actually buy property? This is important because the internal demand, the demand for the people that live, work, and play in an area, is far more important than the demand from investors. We want to be competing with owner-occupiers when we're going after properties. Number 3 is socioeconomics. We want to look at the demographics of the area. We want to look at the CEFA and IRSAD indexes. These are all ABS data points. IRSAD stands for the Index of Relative Socioeconomic Advantage and Disadvantage, based on the percentile of crime and disadvantage in an area, right? We want to look at these things because they can give us an indication as to the socioeconomics of an area. And of course, we want to look at the owner-occupier to renter ratio. We want an area dominated by owner-occupiers as opposed to investors. Number 4 is supply and demand. We want to look at vacancy rates, we want to look at listing levels, stock levels, and days on market. Supply and demand are not created equal. What I mean by that is you want to establish low supply first. That is critical. The reason being is supply is very difficult to fix. It takes years, whereas demand can be switched on in a heartbeat. Policy, just like the first homeowners policies that have just come out or just been updated. These policies, when implemented, can change demand overnight. Demand is very fluid, but supply is very, very difficult to fix. So if you focus on established low supply, you're on the right track. We also want to look at asset level traits too. Block size, zoning, land value, the potential to add value as well. Want to make sure the block is not sloping away from the street. Want it to be on the high side or a flat block. We don't want blocks that are too irregular in shape. All of these things are more to do with capital growth and resale value as opposed to tenantability. So you guessed it, when you get all 5 of those and they all align, you get predictable long-term compounding growth, which is the dream in property investing. Also, if you like, you can grab a free copy of the property questions you should be asking yourself before you buy anything in the link below. Now, on to the juicy stuff. The best areas to buy in 2026. Well, some of them anyway, right? There's a lot of good areas to buy in. These are my picks. I love them. I even have investments here too. Number 1 is Frankston LGA, or Frankston City Council area. Now, Frankston might have this brand among Melburnians as, oh, Franga, a bit rough around the edges or what have you. But that is the beauty of not having that bias as a Sydney-sider, which is why I love it. People dismiss Frankston as, oh, it's too far, it's not premium, it's a bit rough around the edges. But that whole area is affordable, it's owner-occupier driven, and it's in the early stages of its growth. I'm super comfortable with its socioeconomics actually, even compared to some of the other areas I'm buying in for clients. And I absolutely love the supply and demand imbalance. So research Frankston, Seaford, Carrum Downs, those are 3 standout suburbs, and they tick many of the boxes. They don't tick all the boxes because there is never a perfect alignment of metrics in property investing. There are always trade-offs, but that's a story for another time. Area number 2 is Wyndham City Council. I'm talking about Hoppers Crossing, Werribee, Altona Meadows. These are great areas. They're in the western pocket of Melbourne. We've got a great combination of infrastructure, affordability, decent socioeconomics, all strong fundamentals for its next phase of growth. Target sub 1 million or even sub 800, 850K properties that have good land value. Maybe they have some value add potential. And for the love of God, don't get scared off by covenants, because those covenants are just going to be abolished, or you're going to be able to navigate them really easily with the new planning reform that's coming in. But that's a video for another time. Number 3 is Melton City Council area. I'm talking about Melton, Melton West, Kurrajong. A lot of the time this area is discounted because it's so far out, and the socioeconomics are a bit more questionable than some of these other areas, but it is cheaper. You can get stuff for still sub $600,000 there, and you're still in Metro Melbourne. Affordability, population growth, and just coming off such a low affordable base, as I just mentioned, for residents is a really, really good sign. Get really big blocks, 600, 700, 800 square meter blocks for 550 to 650,000. Can't complain about that. So yeah, that's where I definitely want to be too for the next boom or the next run up in this cycle as well. And it's also not a huge ask to say a $600,000 property will be worth 1.2 million in 10 years. Again, is that investment logic? No, but I still believe it. And last but certainly not least is Brimbank City Council area. I'm talking about Keilor Downs, Sydenham, Hillside, and a couple of other suburbs, but a great spot. Not too far from Tullamarine Airport, kind of in the northwest, kind of, I guess. Really strong socioeconomics, so actually even stronger than some of the other areas I mentioned, but still reasonably affordable price bracket. We're talking, $850, $900 and below. A really strong market, good demographics, good socioeconomics, and a shit ton of owner-occupier appeal. The owner-occupier numbers in these areas are off the charts, 70, 80% plus. So very, very dominated by owner-occupiers, so beautiful street appeal, well-kept homes and yards, you know the rest of it. So yeah, check it out. I'd highly recommend it. It's a great spot. I think there's a good mix in there of some, coastal side locations. We've got full-on suburbia with owner-occupied demand and better socioeconomics. And then we have areas that are a little bit lower socioeconomically, but still primed for growth at much cheaper price points. Now, if you want to grow faster, then book a call with me. I'll show you how I've invested in some of these areas personally myself and the system that I use to build a $7 million property portfolio along the way. Now, knowing where to buy is just half the equation. The other half is structuring your portfolio for income growth and compound growth over the long run. So in the next video, I'll show you exactly how I make $17,000 a month, well, kind of, from property investing. And it's the same system I've used for my $7-point-something million portfolio, as well as my over 50 client deals. So click the link and I'll see you there. Toodaloo.